Hi, it's Dan Osman here from UK Moneyman. Here just to give you an idea about how lenders will calculate how much you can borrow on a lifetime mortgage equity release. Lifetime mortgages, which is a form of equity release, they start to become available to people at 55 and go on up. I mean, some of the lenders don't have a maximum age where you can start to apply. So it's 55 onwards. Now, the way that a lifetime mortgage works is that the lender will agree to lend you a certain amount of money, maybe a lump sum, or it may be a smaller sum to start with more money to draw on later. That generally is a fixed rate of interest. Okay, now the monthly payments are voluntary. So if you don't make the payments, then those payments will add on to the loan each month, and gradually the loan will increase in size. Now what that means is that the younger you are, the greater the potential for your mortgage to increase over time. So the way the lenders calculate this is they'll look at someone at 55 and say, well, okay, there's a long time for your payments to increase onto the loan. So we'd maybe lend you somewhere around about 23 to 26% of the value of your property. As you get older, you have less life expectancy left, less time for the mortgage to accrue, so the lenders will lend you more. So at 70, you might expect to be able to borrow 38 to 40%, something like that. And then at 85, it'll sort of top out at around the 51%. Now, there are circumstances where lenders would lend more. For example, if you've got any medical conditions that a doctor would think might reduce your life expectancy. So that's not necessarily things around mobility, but if you've had a history of cancer or heart attack, stroke, things like that, then there are lenders out there who may lend you more for a given age than the mainstream would. And there are also circumstances where the amount that you can borrow might be restricted. So that can come into play with flats, particularly if there are shorter leases involved, and for various other non-standard properties, or non-freehold properties, I should say. So again, really important to speak to an advisor with your personal circumstances in mind, what you're thinking about maybe in terms of downsizing in the future. It may be that a lifetime mortgage, particularly if you're younger, is better left for a few years, and your advisor will be able to talk to you about what the alternatives are now. It could be a conventional interest-only mortgage or a retirement interest-only mortgage. Maybe a repayment mortgage over the short term to look at trying to bring the balance down so that you could potentially release more later on if that fits in with your plans. But speak to an advisor, go through all your circumstances, give them as full a picture as you can, and then they'll try and give you the best advice possible.